Welcome to The Patient Physician, a space for doctors to explore their physical, mental, and financial wellness. Your peers and industry leaders will destigmatize institutional perceptions while redefining success, money, and personal care. Get ready to pull back the curtain because here, you are both patient and physician.
Welcome to The Patient Physician. I'm your host, Paul Smith, joined today by my co-host, Chris Fulbright.
Hello, Paul. Excited for today's podcast. Yeah.
Good. Me too. Today, we're going to be talking about real world money topic that will affect many people's lives for our audience. And today, we're going to dive into one of the most pressing and expensive topics, really the path of becoming a physician and taking student loans. You know, medical school is one of the most respected journeys you can take, but it often comes with a mountain of debt afterwards. And the average medical student graduates with over $200,000 in student loans. I was reviewing some of the numbers. It depends on where you go to find these, anywhere from $230 to $260 and growing, right? So today we are joined by Joe McGrath with GradFin, and he's going to share his thoughts on navigating this world of student loans and repayment. We're hoping to address some smart repayment strategies. He can share with us the real cost of medical education and whether forgiveness programs like PSLF are actually working for the doctors that we see go through this training. So whether you're pre-med, you're deep in residency, or you're already out in practice, this one is for you. So to that, we welcome Joe McGrath on the show.
Thanks, Paul. Thanks, Chris. Thanks for having me on. Excited to be here. And yeah, just to give a little bit of background as to who I am, what I do. I work for a firm called GradFin. I manage the business development team over here. And a huge part of what we do is working with people who are in medical school, residency, fellowship, or practicing physicians to help navigate the very complex student loan landscape and build a repayment journey for these individuals. Because I always say that while it's great to have background information revolving around what's going on in the student loan landscape, it's a completely different conversation to actually sit down with a professional who can carve out a repayment plan that makes the most sense for you. So hopefully by the end of this episode today, we'll give people some good information as to just what the heck's been going on with student loans and how to navigate these waters and find the perfect plan for them.
Well, this is not a small topic, right? I mean, it feels like every time you turn on the news, there's something about the student loan debt. I was just trying to buff up on some of the numbers. Last year, we were closing in on $1.8 trillion. That was 2024. I'm sure we're over that now. Most of that is held by federal loans. And I think that's a big concern, right? Most of that, I think it's 1.6, 1.7 of that. And the staggering figure is that about 21% of that debt, or 1 in 5 physicians that are doing that, hold student loans and hold a massive amount of that student loan debt. We talked about that earlier. Anywhere from 200 to 260 is the average. But we've run into people who have student loan debt as high as 3, 4. Chris, I don't know. What's the highest you've heard? I've heard 600.
Yeah. So far this year, I've had a couple in the 6s, right? Last year, I think the highest was somewhere in the low 5s. We did one of our financial wellness presentations, and then all of a sudden you have a husband and wife, both with student loans. You run into the complexities there as well, and there's the stress that goes along with it. So seeing larger and larger numbers.
Yeah, it's not shrinking. So, Joe, there's just been a litany of confusion, I think, recently. Catch us up with what's going on in the current state of student loan debt and how repayment programs are being looked at, what's going on.
Yeah. I'll say first, I'll try my best because basically a lot of what's going on right now, there's not a lot of clear, roadmap going forward. There's been a lot of things that have been announced. There's been a lot of executive orders. There's been a lot of changes that are supposed to come down the pike. But in actuality, there's really not a lot of concrete information as to what the overall end game is for a lot of these options. And this goes back not even to last year. I mean, a lot of this craziness can go back to March of 2020 when the pandemic started. And a lot of these federal student loan issues began when they froze federal student loans for 3.5 years up until the summer of 2023. And then they turned them back on with the expectation to be that the former administration, the Biden administration, was going to put forward a federal student loan forgiveness proposal, which I'm not sure if people remember, and I won't spend too much time on this part of it, but it was a $10,000 federal student loan forgiveness plan where you would get $10,000 taken off your balance so long as you're below a certain income threshold. That was rejected, and the fallout of that created the SAVE program. Now, any physicians that are listening to this, I'm sure they've heard of the SAVE program. It's been the biggest talking point in all of student loan repayment in the last year or so. And what it was at the time was a new version of what's called income-driven repayment. And I won't confuse people by going too in the weeds on that, but basically income-driven repayment is a very popular repayment option for people that work in the medical field or at 501c3 nonprofits or things like that, because that's where public service loan forgiveness calculates its monthly payments based off of. People typically use income-driven repayment plans. And a lot of people were automatically enrolled into the SAVE program. Fast forward to August of 2024, and they made some changes to the SAVE program because the overall goal when that was created was for it to be more or less the one-size-fits-all, best possible student loan repayment option for borrowers with the lowest required monthly payment and the expectation of some sort of forgiveness. They added a change to it that was going to lower the required monthly payment. There was a block on that. And here we are now, May of 2025. And, the SAVE program, and by extension, a number of people who are enrolled in public service loan forgiveness are locked out of their accounts. This is coming on the heels of March 2025, which has been, in my 7 years at GradFin since 2018, it's been the craziest month of student loan updates, changes, whatever you want to call it, where there were two executive orders that came down. One was a plan to restrict public service loan forgiveness for certain hospitals that are deemed to be engaged in quote unquote illegal activities, and a second executive order that was made to dismantle the Department of Education. And what happened there is a lot of income-driven repayment plans were frozen again, and the changes, chaos, stop-start really hasn't stopped from there. And here we are 2 months later, and we really don't see a lot of roadmap going forward.
So where does this leave everybody? We're trying to help educate people, and the education just isn't there, frankly.
Yeah.
And I think people are scratching their heads going, what do I do? Nobody wants to get behind on payments and have that affect their credit and or getting kicked out of a program. What path? And I guess you're going to be guessing.
Yeah.
What's going forward?
Yeah, certainly. And it's a completely fair question. It's one I get multiple times a day. I will provide as much context as I can on this. The short answer is really it depends. It depends on what the fallout of all these executive orders are going to be. One takeaway that I always say to people is whenever you hear student loans lumped together with executive orders, just know that many, if not all of student loan repayment plans, at least on the federal side, are federally insured. So they automatically have to go before Congress, which could extend this roadmap out even further than they want to right now. But to address your question more directly, basically it all stems from IDR, income-driven repayment, which for people that don't know, income-driven repayment, the easiest way to describe it is a repayment option where you're dedicating typically 10% of your after-tax income towards your student loans year over year. And then public service loan forgiveness, which is an offshoot of income-driven repayment, uses the income-driven repayment plans to calculate their monthly payments. This is where a lot of the craziness and a lot of the sensational headlines you see are coming from. As it stands right now, the SAVE program is the only one of the IDR programs that is completely frozen. Borrowers that are in the SAVE program are put into a forbearance where monthly payments are not owed. However, they're not making any progress towards their eventual forgiveness. So it stands to reason that whenever this forbearance is set to end, which at this point is December, but we don't really know if that's going to be the actual date yet. It might get extended out further. We don't know where that's going to leave people. We don't necessarily know what the fate of the SAVE program is. We know that it's been blocked. So it is going to change in some capacity, but whether that means it reverts back to what it was prior to the change that caused this forbearance, or it reverts back to what it was prior to the SAVE program existing, which was a program called Revised Pay As You Earn. Those are the two less likely outcomes. The more likely outcome is that either they will get rid of SAVE entirely and lump people back into a different IDR plan, or I've seen reports that they are planning to announce a proposal for two new IDR plans that's going to replace all of the ones that are existing. There are 4 IDR plans as it stands. We already covered the SAVE program. Then there's income-based repayment, which is the only one right now that's actually a guarantee that you can enroll and you will get forgiveness eventually. It's the only one that the government seems to be backing right now. And then there are 2 other versions called Pay As You Earn or income contingent repayment. Now, people that are in these programs, these 3 programs, are still having their paperwork processed. They're still making progress towards their eventual forgiveness. However, IBR is the only one that's really safe from any legislation that's coming down the line. People that are in income contingent repayment or pay as you earn, while right now making progress towards their eventual forgiveness, there is the possibility that down the line they will get rid of those programs and revert back to IBR. In terms of what to do right now, one, not to sound too salesy, but my contact information I believe will be shared at the end of this. I would recommend connecting with my team for a consult. But for a more direct answer to that question is look into what your overall goals are. For people that are in the SAVE program, right now, okay, you have to look at it as like this. Am I in the SAVE program to get forgiveness, or am I in the SAVE program to give myself a lower required monthly payment as a short-term option and then decide what I'm going to do down the road? Those are basically your two decisions. If you're looking for forgiveness, it might be in your best interest to try to revert to the IBR plan, which my firm GradFin can assist you with. If it's the alternative where you're just using this program as a short-term option to have a lower required monthly payment and then figure out a more permanent repayment plan down the road, you can use this forbearance to your advantage. You could throw a little extra money at this thing. Everything you pay right now goes directly towards the principal balance, so it can't hurt you. You're going to pay.
So what's going on with the interest? Is there nothing that's being accumulated? It's sitting at zero or on these months where there's nothing happening?
Correct. There's no interest accruing. So in effect, the loans are just sitting dormant. But the big risk there is, and this is where it differs from that COVID freeze, from March 2020 up until August of 2023, when that federal freeze happened, people didn't have to make payments and interest didn't accrue. But all of those months and those years eventually counted towards someone's forgiveness. Right. So if they were in public service loan forgiveness, they had that 10 years. And suddenly a lot of people, if they signed up for it early enough, they ended up having 3.5 years that counted towards their forgiveness where they didn't have to pay a dime. This is different. The SAVE program here that's in forbearance, while monthly payments aren't owed, interest isn't accruing, it's not counting towards that eventual forgiveness. Now, an important caveat there is looking at it through an historical lens. In the past, when there's been these types of forbearance that go on for X amount of months, the government typically, and I say typically with heavy emphasis there, will offer the opportunity down the road for people to retroactively get back into repayment and have payments count that didn't previously. In the past, there was a form that was called the one-time adjustment, where people can use an online form, sign up in the Department of Ed, and retroactively get payments counted. And then as of right now, there's also a PSLF buyback option on studentaid.gov. Now, the process there is very complicated, so I won't get too into the weeds there. And also, full transparency, a lot of these forms dating back to last summer have not been processed yet, but they still offer a processing form where people can retroactively get back into repayment. So basically, what your plan is or what your overall goal should be really depends on what your current situation is and what your current IDR option is that you're enrolled in.
You said that the IBR, right, is the one that is the safest. Is that right? If I'm remembering the different plans that you talked about, that's the safest in terms of sticking. Kind of a two-part question here. Sure. Why that one? What is it that the government likes about it that okay, that's safe in your eyes? And then this may be a dumb question. Why so many different options? What is it about that is there flexibility that they keep going, oh, well, wait, this will work better for this person? Why can't there just be one plan? Is there, and not that every, one size fits all, that's not really the case, but it also is very confusing when you have several different options. You keep trying to reintroduce things. Good luck with that question.
And I'll try to tackle it to the best of my abilities there. So in terms of why IBR's income-based repayment is the safest, is really because I think it's the most standard option. And it's the one that they could probably make the most changes to down the road if they do plan to, quote unquote, fully dismantle IDR. And I think a lot of what their overall goals are right now is to simplify income-driven repayment as a whole. In terms of why pay-as-you-earn and income contingent repayment, the two programs that are still available and payments are processing, might go away. And I say might because we can get 3 months down the road and these programs could be reinstated. We really just don't know yet. I mean reinstated fully, which means there's no risk of going away. Basically, I think the reason why IBR works is, one, a lot of times they can get away, they being the government, with charging a little bit more as opposed to the different IDR plans. Depending on how much you make and how you file your taxes, you could have, instead of paying 10% towards your overall student, or 10% of your after-tax income towards your student loans, sometimes it could be as much as 15 or 20% on IBR. So that way the government's going to get a little more money and also limit the amount that you're going to get forgiven at the end of the road. And two, a lot of what's going on right now is kind of a short-term knee-jerk reaction from the government. To provide a little bit more context, there was a lawsuit that was launched back in March 2020 when the second of the two executive orders came down. The second executive order was the one that further dismantled the Department of Education. Now, to give full context here, the government's overall goal with these executive orders to dismantle the Department of Education isn't necessarily targeted towards college planning, college financing. They're more concerned with letting education be decided on a state-by-state level for pre-K through 12th grade. They want states to decide, how much money is invested towards public school, how much school is required, et cetera, so forth. Student loans are just kind of wrapped up in this, college student loans, I should say, are just wrapped up in this just due to the craziness that's going on and sort of the stop-start nature of everything. And when this executive order came down, one of the additional points was they froze all IDR plans. So it wasn't just the SAVE program. Suddenly, all 4 IDR programs, people were locked out of their accounts and everyone was in the same boat. And I think, and again, I think, this is me speculating, their goal there was to, while everything was frozen, put their plans into action to, just take away those 3 other IDR programs, let IBR stand, or replace it with 2 new programs. But there was actually a lawsuit that was launched by this teacher union. I believe it's called the American Federation of Teachers. They're a union with about 1.8 million members. And they launched a lawsuit saying, hey, you can't just dismantle student loan repayment option for all these borrowers. You have to allow people to get a roadmap towards forgiveness. You can't just lock them out of their accounts. And frankly, they were right in saying that. And this one lawsuit from this one union moved the government's hand and caused them to reopen those 3 IDR plans, sans SAVE. SAVE is still in that forbearance. So that leads me to believe that the government's just sort of acting on instinct right now, and they're putting these proposals together to see what sticks. It just lends credence to the idea that we really don't know where these things are going to go. I hope that answered your question. I took us down a journey there, so I apologize if we went a few different directions there.
No, I think that colors those lines. Yeah, Paul, I think that's colors those lines in better, Joe. I'm listening to you talk. I'm listening to physicians we're talking to. Mm-hmm. A lot of unknowns. Yeah. A lot of uncertainty. You're hearing this may go away, this stays. Why should a physician at this point, that's our target, that's who we're mm-hmm. speaking to primarily, why should they go sign up with somebody right now and start a program, start down a path when they don't know if it's going to be the same program in 3 months, 6 months? Yeah. Are they throwing good money away? Are they losing interest payments? What would you recommend to somebody who's just starting, right, completing training? Do they commit to something or they wait and see and hope that a solution is going to be available?
So the answer there is sort of both things you said. You can enroll in an IDR plan. At this point, I would recommend enrolling in an IBR just to be safest, because that's the only one that's guaranteed to continue in some way, form, or fashion. But one of the great things about PSLF, and although PSLF has many issues, one of the benefits of it is you can enroll as soon as you get into residency. And if you enroll while you're in residency, you can take advantage of 3 years or so of payments where you have a very low required monthly payment. There, when you finish residency and go into fellowship, or when you complete fellowship and then become practicing, whatever the situation may be, you can kind of let that decision be made down the road in terms of what you're going to do, whether you commit to staying in PSLF, and hopefully at that point you will have some concrete answers as to where PSLF is going or what the changes are going to be to it. Or you can make that decision at a later point to get out of IDR and go into a refi. Some people are just sick of the stop-start nature of IDR, federal student loans, and a lot of physicians have the means, they have the income just to pay these loans off, and they can just look into a refi. And if you refi, there's a ton of flexibility there. And I should also add, some people have careers that make this decision for them. They don't want to work for a public hospital. Maybe they get a great offer from a private practice. A private practice can't offer PSLF because it's not a public hospital. So from there, you can either commit fully to just IDR on its own, or probably in this case, just look into a refi. So what I'll say to people who are maybe just starting their journey and going into residency, if you're concerned right now with, oh my God, what am I going to do? Do I just sign up for this program? What if it goes away? The good news is you have some time to make that decision. You can enroll in an IDR plan right now, IBR, whatever the situation may be, and basically just wait it out to see. or you can just use it as a short-term option. So it really depends. Refi is still a great option for a lot of people. Rates have dropped in the last few months, especially compared to where they were late 2022 and 2023, early 2024. We're seeing rates that have been the lowest they've been in 3 years. So refi is still a great option, especially for people that have the means to pay off their loans and are just sick of the stop-start nature. But it depends on a number of different factors.
Is there a cost to refinance, right? You're talking about rate changes. We're recording this kind of mid-May 2025.
Sure.
What rates are you saying good rates? What are those in comparison to? And then if somebody's coming out, they're thinking refinance may be my best option. Is there a cost next year to redo it? Like I think we're all familiar with you refinance your house, you do mortgage. There's a spread in there where it makes sense over a period of time. Can you talk to that from a student loan perspective?
Yeah, absolutely. Through GradFin, what my firm does, there's no cost to refinance. How it operates is we're a broker. We have multiple different lenders on our platform. And the idea is if you look to refinance with us, we will match you to a lender on that call, get you pre-approved for the refi. And then all you need to do is fill out that application. And it's as simple as your loans transitioning either from a federal student loan to a private loan at that new servicer, or if you have an existing private loan, which some people do, just moving to a new servicer there. No closing costs, no cost to refi. You're simply shifting your loan over to a new servicer, new interest rate, new term, whatever the situation may be. How we get paid on that side of it is, since we're a broker, those banks send us a check for sending people their way. We basically commission a referral fee for sending people over to them.
So where are you seeing interest rates currently?
Obviously, it's a floating scale there. It depends how you're evaluated for a refinance. The bank will look at your income, your credit score, your debt to income ratio, which is how much money compared with other debt that you have, your savings, and of course, your level of education. Now, most physicians check a lot of that boxes. And even if they're not making that much money right now, if they're in residency or whatever the situation may be, these lenders know that. It's called a Henry, a high earner, not rich yet individual. I actually haven't used that term in about 2 years. So I'm glad to know I still know it. But yeah, these lenders know that, hey, this is an individual that will make more money down the road. So they're more inclined to offer them a more competitive refi. In terms of where rates are right now, we pulled rates as high as 3.88 last week. I'm not going to say that's going to be the case for every single person, but on average, I've been saying about 4.5 to 6 typically is the range that we're seeing, which again, from a historical standpoint, that's where rates were pre-COVID. I joined the team over here at GradFin in 2018. I would join January 2018. And from 2018 up until 2020, up until the pandemic started and rates started going up and down and all around, on average, refi rates were around that 4 to 6 range. So it stands to reason that, we're kind of getting back to where things were. And, just to compare that to other average rates that you see, yeah, sure. Typically, if you originate a federal student loan, on average, that rate is going to be somewhere from 4 to 5.5. But when compared to things like Grad Plus loans or Parent Plus loans, which are different types of federal student loans where either the parent is a cosigner or, the individual is going to graduate school or medical school or something like that. On average there, the Department of Education is going to slap that with a higher interest rate because it's either people that the loans are in the name of that are already established and are making money, or it's someone that's going to be set to make money in the future and be able to pay off these loans. So they're going to give it a higher interest rate. On average there, it's not uncommon to see high 6s to 8%. And then private student loans, you never know what you're going to get. Existing private student loans can be anywhere from a 5% up until I've seen as high as 13 or 14%. So again, in the grand scheme of things, 4 to 6, you could typically find some improvements there based on what you see on an average compared to all different student loan types.
It's good to hear that the rates have come back down and you're seeing it as kind of attractive. But Joe, I thought that, and this may have changed because there's been obviously a bunch of changes stimulated this discussion anyway, but I thought that if you refied, you can't come back to the federal or be part of the PSLF program again. Is that still the case?
That's correct. Yes, that's one of the risks that are wrapped up there. Federal student loans are the only type of student loans that you can enroll in public service loan forgiveness with. Private student loans, you cannot. So that is one of the risks that is wrapped up in refinancing. Now, if you take a consultation with my team, we're upfront about that. And the whole point of our call is carving out a repayment plan that makes the most sense for that specific individual. So it all depends on, what your goals are and your comfortability with risk. With a private student loan, it acts more or less the same as a personal loan. It's an amount that you owe, they slap an interest rate on, they give you a term, and you're paying that thing off. There's really no two ways about it. Now, that doesn't mean that you can't still improve that loan or get yourself into a situation where you have a comfortable monthly payment. One example is if rates drop again in the future, you can always refinance again. You can refinance as many times as you like. So if rates keep dropping, you can keep refining, changing the term, getting yourself lower interest rates. And then another common one, and one that I see physicians do quite frequently if they're going to refinance is, they'll connect with someone on our team and they'll say, hey, I just want to pay this thing off. I have the means to pay it off. Give me the shortest term. Give me a 5-year and I'll just get this thing done in 5 years. A lot of times we'll say, okay, great. Yeah, you can certainly do that. But instead of doing that, why don't you give yourself a little bit of breathing room? And instead of a 5-year, take a 7-year or an 8-year or even a 10-year. Our terms go up from anywhere from 5, 7, 8, 10, 12, 15, 20, or 25 years. But why would you give yourself a longer term? Well, you're going to give yourself a lower required monthly payment as a result of that. The longer the term, the lower the monthly payment. And private student loans have no early payoff penalty. So if you get yourself into a situation where you have a low required monthly payment, you have some disposable income on the back end of that, you can throw that right at the student loan. It goes directly towards the principal balance, and you can end up paying that loan off in an even shorter amount of time. Like I mentioned, private student loans, no early payoff penalties. There's not a lot of risk to it. And then, hey, a month pops up where you want to take a vacation or, a life event gets in the way where you can't throw that extra money at. Great. You have a low locked in monthly payment and you don't have to worry about it. You just make that and then, figure out the next month what to do. So again, there are workarounds there, but if you do refinance it, you're doing that knowing that you're losing the eligibility for public service loan.
Yeah, you're done. You don't come back to be able
Correct.
To move them back to federal. So the message there is really you need to kind of know your path. That you're not going to go back to some sort of employment situation where you're going to qualify to continue to make payments for PSLF, right?
Mm-hmm.
I mean, that's the ultimate one that people are after anyway. You said something made me think that maybe PSLF is at risk. I think a lot of people wonder whether that's even real. That was signed into law back under Obama, right? I mean, that was first.
No, Bush actually.
2000 Bush, was it? Okay.
Yeah.
So it's a long time. And I think the first round, when people actually satisfied that first 10 years, they weren't seeing forgiveness and it created some frustration. But there was just because there were these hoops that people weren't really paying attention to. And of course, leave it to our government to put some stuff in there that the people weren't paying attention to. It's great. Thanks so much for that.
Or them. Yeah, or them. Yeah,
well,
the government
look,
or the physician. Yeah.
In any of the physicians' defense out there, look, they're incredibly busy, and so you could put a thimble of requirement there, and they would stumble over it because they're just too busy to pay attention to a lot of the small details like that. Mm-hmm. And I think that's created an incredible amount of frustration. But I think one of the best things, and I will prop your firm for this, is that one of the best things that y'all came up with was a way to help them manage through that so they don't miss those. Yes. And that they are getting the counting. Because if you're going for that, you don't want to get to the end of 120 payments and think, I'm home free, apply for it, and then find out what's the biggest problem. I haven't actually been working for a qualified employer, even though I think I have. I'm actually I'm contracted through somebody who's subcontracted through a hospital system or something like that. Doesn't count. And that's, I can't imagine how frustrating, I've been paying. So do you see that quite a bit? I mean, I've heard those stories.
Unfortunately. And like you said, this is a problem that goes back to 2007. Basically, the program was put together as a response to individuals who worked in the medical field, or a big part of it, it's not talked about all that often, is public school teachers who have this available to them, who, although their balances weren't crazy, they weren't making that much money. They weren't really bringing in the big bucks. And they said, it was a collective call to action. People were saying, hey, we need assistance here. We need a plan. We need some sort of expectation that the government's going to meet us halfway. And they put together public service loan forgiveness in 2007. It was put together rather haphazardly. 2017 hit. The first round of applicants hit the finish line. At the time, 99% of people were rejected for forgiveness. Now, 99% of people. Now,
that's a high percentage, Paul.
That's pretty high percentage. Yeah.
I mean, there's that's
rejected. 99% rejected.
Well,
exactly. Yeah.
Good for that 1% then.
Right. Yeah. And the problem is, here we are 2025, and I'm not sure what the exact percentage is, but I mean, this is just me shooting from the hip. It's probably around, 85 to 90% of people still get rejected. And there's a number of different reasons for that.
85 to 90 still.
Roughly. Yeah. That's me just pulling a number out of thin air.
What are the current reasons?
Yeah. So a number of different reasons. Biggest one is obviously everything that's going on right now. The freezes, the forbearances, the stop starts, people fall out of compliance. They're not even aware. One of the biggest ones out of COVID, and again, I hate to keep bringing up that COVID freeze because it's already in the rearview mirror, but it's still causing a ton of issues on the back end of it. Basically, a lot of people had 3.5 years where they thought to themselves, "Oh, great! I don't have to worry about this. I'm set to jet. I'm going to have 3.5 years that count towards my forgiveness," not knowing that. Sure, they didn't know anything and interest wasn't accruing, but they still needed to be filing all the annual paperwork as if they were in repayment. And a lot of people just didn't. And they ended up losing, X amount of years as a result of that. Now here we are with the SAVE program being frozen. People are coming up on a year now where they're not sure where things are going to go. On top of that,
before you get too far, can you retroactively go back and request to get that satisfied, or are they just screwed?
There is a form that's available. It was rolled out last summer. It's called the PSLF buyback form. It is still on the Department of Education's website. However, payments or requests, I should say, on that have not been processed in a number of months.
Is that because there's nobody there at work?
Probably, yeah. It has a lot to do with it. They got rid of half the work staff over there. So
one little person,
and you already
couldn't know what to do.
And you already couldn't get people on the phone to begin with when they were working with the full staff. So, that's one of the issues there. So they do offer it. And again, historical context being what it is, when that COVID freeze ended, they did offer what was called a one-time adjustment where they allowed people to fill out a form and retroactively get back up to date if they didn't sign up for PSLF in time. And obviously there was a few caveats to that. You needed to be doing things correctly. There was a certain number of rules in order to get that those payments retroactively counted. But that leads me to believe that whenever the forbearance on SAVE ends and we know what its fate is, whether it's, reverting back to what it was or creating a new IDR program or going into IBR, they have offered people the opportunity to retroactively get payments back. So that's my hopeful side. That's my optimistic side, that they will allow people to get those payments back. But one of the biggest issues.
So let me. I'm sorry, Joe. I want to make sure that I'm understanding this so that the audience listeners are understanding.
Sure.
So if I'm in SAVE and I can't do anything right now, am I understanding that you're suggesting maybe the best scenario is to continue to set aside the money I might mail in so that when this thing clears, if they give me an opportunity to send in the money to catch back up, are you suggesting they're going to require the payments to actually qualify to then get counted? Or
I don't know for sure, first and foremost, but I don't think they would retroactively demand that you pay over a year's worth of your student loan payments just to get up to date with everything. My assumption would be that they would just offer a form that you would fill out and you would say, hey, I, would have gotten these payments counted because I'm in the correct program, and hopefully they'd bring your qualified payment count up to date. But again, I should reiterate that people that are really dead set on making sure they're on track and getting their forgiveness counted, they should look into going into the IBR plan. Again,
and not wait.
Unless they're just using SAVE program as a short-term option to have that lower required monthly payment and figure out things down the road. If they want to run the risk of losing IDR, because again, I say they may offer people that buyback period, and I think they will at the end of this, but it's not a certainty. The only certainty right now to make sure that you're getting these payments counted is to go into the IBR plan.
To really clarify through the mud that we're trudging in. That's what it feels like. I'm sorry for stopping you.
No, I always say IDR far and away is the most complicated thing in the student loan landscape. There's
the whole thing, right? You need to have a college degree just in this. It's ridiculous. So you're saying that the SAVE program is in freeze, right? So you're saying get into IBR, but if it's frozen, your account's frozen. Can you actually still do that? Can you make the transition out of it?
It's going to take a little bit of work, but you can do it. That's majority of what our consultations that we're doing right now for people that are in the SAVE program is figuring out, okay, what's your path on getting over to IBR to get up to date with compliance on everything? Or do you want to run the risk of just waiting it out? So that's kind of the decision that needs to be made. So you can shift over, but whether or not it makes sense to do that's a completely different conversation.
What's the risk time frame realistically? 2 months, 6 months. They're not going to kick this down the road for another year, right?
Oh, okay, it is our government. I made a face there.
Dramatic pause.
Very
dramatic.
Sorry, we are talking about the federal government. I apologize. Yeah, it'll be 2 years. I apologize.
Yeah,
I underestimated.
As it's set right now, December is the date for all this to be decided. And I'm hopeful that's when everything is, and hopefully over the course of the summer into the fall, they'll start announcing what the final decisions are there. It's making sure you're up to date with everything. So all that to say, though, and this is another point that I wanted to make before with PSLF and making sure you're up to date with everything. I can't tell you how many people connect with us who are in year 7, 8, 9 that say, hey, can we look back at everything to make sure I'm good to go and up to date? And, I always say, yeah, it's possible to do that, but you're running the risk of figuring out that you've missed a year's worth of qualified payments, a year and a half. And one of the biggest risks and reasons why that rejection rate stays as high as it is because if you're rejected for forgiveness on PSLF, it's not like you can figure out what happened, make a phone call, and apply again next week for the forgiveness and get forgiven. You automatically have to wait a whole calendar year in order to apply again for the forgiveness. And if you don't know where that mistake was made, whether it be in year 2, 3, 4, up until 9 and 10, suddenly you're going to find yourself without any assistance whatsoever, sifting through 10 years of loan payments, looking for that proverbial needle in the haystack. So it's all about connecting with someone as early as you can to make sure that from at least, hopefully year 0 up until the end, that everything that you're doing is counted, locked in, qualified towards your forgiveness.
Okay, so I'm going to put you on the spot because you're saying 85 to 90%. That's a high number. It's just kind of crazy, actually.
Down from 99%, though, Paul.
Yeah,
right. So you're right, Chris. On the positive side, there's some success rate out there.
That's right.
But what I'm more interested in, Joe, and I'm going to give you what is GradFin success? Do you all track that in terms of once somebody's contacted you and gotten a handle on okay, here's where you're at, and you get them in your system of trying to follow up and file all this stuff? What is GradFin's success rate of getting things filed and forgiven after the time?
Yeah. So what we offer is a membership that acts in a way, some people use the word insurance. I prefer the word assurance that you're doing everything correctly. So basically the process works like this. You connect with us for an initial consultation. If we forecast that PSLF or IDR, we talked a lot about PSLF on this. I don't want people to forget that IDR on its own is still an option. It's a longer term. Instead of 10 years, it's 20 years. But again,
and you said there's forgiveness at the end of 20 years, right?
Correct. Yeah. With IDR, which is open to all federal student loan borrowers, you can enroll in an IDR plan. You get forgiveness after 20 years or 25 years, as opposed to PSLF, which is 10. The other big difference
right before they have to file for Social Security.
Exactly. And the other big difference there is IDR, when you get that forgiveness, everything that's forgiven is considered taxable income. Whereas with PSLF, it's forgiven completely tax-free and you're set to debt.
Which is huge.
Yeah, a big difference there. It's half the time and no tax for PSLF. IDR, that's really a case-by-case situation, whether or not it makes sense to enroll in that on its own. But to get back to the question at hand, the process is fairly straightforward. When we connect with someone in our consultation, if we see that PSLF or IDR is an option for them, and then the conversation shifts to, okay, should you continue down this road? Is this the right fit for you? We'll offer what's called our PSLF or IDR membership. What this membership entails, and it is a fee-based program. We do charge for this program. It's the only thing that we charge for. It costs $549 a year, which equates to roughly $45 a month. But what that $45 a month ensures is that you're going to be up to date with all of your payments. We're going to meet at minimum biannually to review each 6 months of payments to make sure everything's up to date. And we bring you right up to the finish line with all of your payments counted, locked in, certified, ready to go. So that's a big part of it. 2, if things do change, people that are in the SAVE program or people that are in different IDR programs that might go away, might change, you're always going to have a representative on our team that you can connect with to make sure that you can get, up to date with everything or enroll in a new program or whatever the situation may be. And then every single person that we talk to that's in the SAVE program right now, if we're not going to be able to help them in whatever capacity, we're going to make a concerted effort in December, hopefully sooner, it might be December, it might even be later, when everything is resolved, that we can reconnect with all of those individuals to rerun numbers when everything opens up again. So basically what that fee-based membership ensures is that all of your payments are going to be locked in. We review all the annual paperwork. We track everything. We remind you when payments are due, when recertification forms are due, and we bring you right up to that finish line at the 120 payment month mark, the 10 years of payments, with everything locked in, certified, ready to go.
So when you say certified, like you, like what? What is success rate? We'll go back to that. What do you?
The only time I don't have an exact figure.
Certified.
Yeah, no. So certified means that all of your payments that could count will count. You've satisfied the 120 qualified payments. At that point, all you need to do is fill out the paperwork. Now, I don't have an exact figure of what our approval rate is, but the only time people will get rejected after that point is if they made a user error or just an input error when they're filling out the paperwork for the forgiveness, which is very, very rare. So I would say I'd be shocked if our approval rate for forgiveness is below 96 or 97%, if that.
So you're flip-flopping the table. Look, it seems reasonable. We're not talking about $10,000. We're talking about hundreds of thousands of dollars. Yeah. And so I find value in it. I've shared it with people. And by the way, we have no stake in this claim except to help people get this stuff off their shoulders, because Krista and I have visited with physician after physician after physician, and there's this weight on their shoulders, the emotional stress that they carry. And it's almost like they just don't want to talk about it because they don't even know how to deal with it. So it's real, the stress, and I feel for it. So I'm just hoping that's why I was excited about having this discussion today. And that's about trying to provide clarity and helping people get that paid off.
Yeah. And what I'll add on top of that too is, like, just to put it in the most blunt terms possible, federal student loans aren't going away. You're going to see a lot of sensational headlines that are saying, again, even the term dismantling the Department of Education. What does that really mean? We don't really know what that means, but we know that federal student loans are not going to go away. Whether that means if the Department of Education is done with it, they want to shift it over to the Treasury Department or whatever the situation may be, they aren't going away. On top of that, too, is if they were to mandate or make some massive change to PSLF, or even in the worst case scenario, get rid of it outright. There's going to be a number of different lawsuits. I use this example. I'm broadcasting here from Philadelphia. I live in Center City, Philadelphia. On my right, I can see the campus from here. It's Thomas Jefferson Hospital. Over there is University of Pennsylvania Hospital. They are a health network with a near endless number of resources. And if these executive orders do go through, and this impacts their ability to recruit new people to come into their health systems, or if these executive orders are going to restrict the kind of options they can offer to patients, which by extension would limit the amount of doctors they can bring in to do whatever that procedure may be or assist in whatever way. If that's going to impact their bottom line of bringing in new people, and, again, this hospitals are talking about here, bringing in more money and helping more people, whatever the situation may be, they're going to fight back tooth and nail. And we saw one lawsuit get launched by a teacher union, the American Federation of Teachers, that actually caused the government to move their hand. This is just one union of teachers, not even health systems, that forced the government to reopen the 3 out of the 4 IDR plans. If they were to make any massive change in the future that limited people's ability to get forgiveness, whether they cut themselves off at the knees and say, hey, if you haven't been in this program for 5 years at this point, you can no longer get forgiveness, the fight back there, or the response to that, is going to be pretty massive. So I would expect, even in worst case scenario, if they revamp everything entirely, I would expect, or I'd be shocked if they didn't allow people to be grandfathered in on previous iterations of the program, or, that's just one example. There are going to be options for people. So I don't want people to sit in for this podcast and think, oh my God, what are my options going to be? I'm more confused than I did walk in. At the end of the day, it's going to work out for them. There is going to be options for people, and they will come up with a plan that's going to be most beneficial to student loan borrowers, I guess, for lack of a better term.
Okay. So if we're thinking through this, I want to lower the threshold of concern, or something may cause someone to hit pause, Jim. Yeah. So they reach out, they schedule a meeting with your team. What would you want them to bring?
Yep.
And then also, who should attend the meeting? So they're completing training, they're starting their career. If their parents had taken student loans out for them, should they attend? If they're married, should the spouse? Do they need to bring their new contract? Like, what information would you need from them? Let's make it easy for them to schedule a meeting.
The great news is our process is fairly straightforward. All you need to do is shoot me an email, and I believe that my contact information will be attached to this. So you'll reach out to me. I'll send you a link. It's called GradFin Concierge. That link is going to be all you need to fill out in order to get a call book. Basically, you'll create a profile on our dashboard, and you'll be prompted to upload your loan statements. We'll need your it's called an NSLDS file. What that is basically just your student loan form that you get from studentaid.gov. We provide instructions on how to get that. Basically, studentaid.gov is the website that covers everyone's federal student loans. Even if you have your federal student loans from Nelnet or something like that, studentaid.gov has a record of that. You get that form. you upload it. If you have private student loans on top of that, you can upload those. You can even just type those in. Those are a lot easier to get over to us. Once you fill out that form and you agree to the consent to have the conversation, a calendar will pop up and you'll select a time to talk. In terms of who attends the meeting, it really depends on the types of loans. Now, if you have Parent Plus loans and the parents are on the loans, it would probably be a best fit. Unless you're looking to just refi, it would be in your best interest to have the parents on the call as well. If you want your spouse on the call, or say it's a situation where you want the spouse to cover the call on your behalf, you can certainly do that. We just need you on the line. Or actually, let me stop there. If you want anyone to cover the call on their behalf, say they work with you, Chris, or you, Paul, and they say, hey, I want my advisor to do this for me. I'm too busy with boards or whatever the situation may be. That's fine. We can say, great. We just need you to hop on that call for 2 seconds. Say, I give consent to have this individual, be it their advisor, their parent, their spouse, sibling, friend, whoever, to run the call on my behalf, and then they can hop off from there. It's really as straightforward as that. On that call, we'll run through all options. We'll compare and contrast things like PSLF, IDR, refi. We'll run refi numbers for you. And I'll reiterate this as well. The call is completely fee-free. And even if you connect with us and we have this discussion and we decide that PSLF or IDR is the way to go, you decide after that call whether or not you want to sign up for the membership. As part of the free consultation, we'll provide you 2 things. 1, your estimated forgiveness date and your estimated forgiveness amount. And then if you say, I'm comfortable doing PSLF on my own, I don't want to sign up for any additional service, great. Good luck. We'll talk to you down the road. But then after the call wraps up, if you say, hey, I want this assistance with PSLF or IDR, great. We'll let you know how the membership works and go from there. So the process, there's no obligation. It's just a discussion. It's a 30-minute call where we sit down with you, break down what your loans mean, how they're going to change over time. Most importantly, answer any direct questions that the borrower has, and then provide them a detailed plan on what their next steps are and what their options are.
Fantastic. Well, thank you for joining us, Joe. This obviously is something that's very pressing for our physicians as they're exiting, not just the exiting training now and starting their careers, but the refinance, the question of the huge decision, PSLF versus IBR, like all of those. We value y'all's partnership. We really thank you for this opportunity. Again, for those that are listening, you're going to have Joe and his team's contact information, the link in the description there for GradFin as well. We have had huge success. And so we want to thank you for that, for the people that we've sent over to y'all. Again, thank you so much for your time. We will talk to you soon, Joe.
Absolutely. Thanks, everyone. Have a great day.
Alrighty.
This conversation was brought to you by Physicians Resource Services, a firm supporting medical professionals to improve their financial situation and pursue their personal and professional goals. The Patient Physician is produced in Austin, Texas. Editing and sound design are in the hands of the PodConnects podcast network. Please email questions or show ideas to info@physiciansrs.com.